Hello sector watchers, welcome to the show. This is a special edition of Sector Spotlight, a special episode of Sector Spotlight, and I want to create this short video to go over the use of different benchmarks and the different use cases for benchmarks, because I get a lot of questions from people asking about benchmarks and they've heard me talk about specific benchmarks. So I thought it would be a good idea to do a short video and explain all of that instead of having to type all the emails to answer all those questions. So if we start with benchmarks, obviously the benchmark is one of the key components of a relative rotation graph. It dictates how the universe of securities will rotate, and around the benchmark it will rotate. On the screen is the probably most widely used RRG of the 11 S&P sectors, in this case the sector ETFs, with the S&P 500 or SPY as the benchmark. I'm going to assume you know and you're aware of how that works and what it does and how to operate this chart. What you need to remember and what you need to know is that the benchmark is the chart that is in the sidebar right here. So here you see the chart of SPY and you see the rotation and the relative trends of these sectors against SPY. Now, when we move to, for example, a sector, then we can load up. Let's start with the members of the communication services sector. Why not? And you see that in the drop down immediately XLC, which is the sector index, has been selected as the benchmark. The reason for that is that it makes a lot of sense to compare the individual stocks in a sector with its sector benchmark, because if a sector is particularly strong or particularly weak, what you will see is that all the stocks will cluster in the same direction because the sector itself is so strong. So if we would change the XLC benchmark back to SPY, we are then looking to the rotation of all the stocks versus SPY and not anymore versus XLC. And you can see that this universe didn't really change a lot because XLC went through, by the time I'm recording this, that it is mid-July 2023, communication services went through a big rally and is now coming off a little bit. I know that the, let's say the staples and the utility sector are in relative downtrends. So if we load up, I'm going to expect, so this is a surprise for me as well, I'm going to expect that the members of the utility index or the staples index, whatever we choose, will show a significant bias towards the lagging quadrant. So here's utilities. Here's utilities against the utility index, and you can see how it's spread out. And now the proof is in the pudding. When we change this to SPY, look at that. Here you can see how the general weakness of, in this case, the utility sector is displayed on an RRG versus SPY. And now imagine that you are a fund manager, maybe a professional fund manager, and you know that utilities is a very weak sector. However, you still need to have some allocation to that sector because of portfolio constraints, or maybe you're managing a utilities portfolio. So what are you gonna buy? What do you need to buy to actually outperform that index? And it's quite clear that here in this universe, Constellation Energy is one of the few, and then it's got Honor NRG, which are doing really well. So in this way, you can get a handle on the rotation of the members of a sector against the S&P. And if we bring this back to the utilities sector itself, you can see how that universe is performing against the utilities index. And we already saw that Constellation was very strong and NRG, but when you need to beat that utilities index, a few more opportunities show up, and these stocks are in relative uptrends versus the utilities sector index. But we just saw on the RRG that had SPY as the benchmark that they were all clustering inside that lagging quadrant. So that's how you can actually play around with different benchmarks to get a different angle, a different look at a specific universe and a specific RRG. You can do that for every sector, of course. You can do that for every universe. Now, this is the original way of using RRG when it originally started. And as you may know, I was working as a sell-side analyst for an investment bank dealing with institutional investors. And this relative strength stuff is pretty much their bread and butter. It's all they were interested in. They weren't really interested in absolute price moves because they couldn't get in and out of a stock anyway. They couldn't get out of a stock or out of a sector or get a portfolio to 100% cash because their portfolio constraints were dictating that they needed to be almost 100% invested. So their game was to find outperformers in that big heap of stocks and sectors and weed through it and find the outperforming sectors and the outperforming stocks, even if that meant buying stocks that were going down in price. The only thing was that were going down in price slower or less than the benchmark that they were measured against. Now, ever since RRG came to stock charts, obviously the audience and the users of stock charts are predominantly retail investors. I won't say everybody, because I personally know quite a few professional fund managers that use the stock chart system, but there's obviously a lot more retail traders and retail investors, and they tell me that I don't really care about the relative performance. Well, to be honest, retail investors are probably the most difficult crowd to cater for, because they want to outperform the index when the market's going up, but they don't want to lose money when the market's going down. And that is a super difficult benchmark. So you need to buy the outperformers when the market's going up. But as soon as the market starts coming down, you need an absolute benchmark because people don't want to lose any money. And it took a while to realize that, but I figured out that, and this is way back, it is possible to turn an RRG into a tool for absolute price performance, or to look at the development of absolute price trends. And the way you do that is to use a special benchmark, which on the stock chart system is $1. And what $1 is, and now you need to watch, because on the here we've got the utilities index as the benchmark, so you see a chart that goes up and down. And if we now run this universe against $1, you see a flat line. And that means that now, because this is a line that's always 1, the relative component is taken out of the algorithm that dictates the RRG tails and the RRG indicators. So by using $1, all of a sudden you get a handle on the absolute price trends. And although it looks a little bit like the chart that we just saw against SPY, it's definitely different. So you see that there is a few here that are coming up, and against SPY they were all in the lagging quadrant. But by using this special benchmark $1, it allows you to look at an entire universe of stocks and make an assessment of the price trends in absolute terms that they are going through. And that's a really helpful tool if you're in a position where you manage your own money, or you have the freedom to go cash if you want to, because if everything goes into the lagging quadrant, that means that all these trends are going down, which means that all the prices are going down, because this is looking at absolute price trends. Then using $1 can definitely be a good help to pick and choose your investments. And then finally, there is a third benchmark that came up, because this is basically absolute return. Just the zero line is your benchmark. Now, if you're an absolute return investor and you have like a desired annual return that you're after, hedge funds do that all the time. They want to beat 10%. They always want to beat 10%, or 5 or 25, or just pick a number. It doesn't really matter. What you can do is stick in a benchmark based on a user-defined index. And how you can make user-defined indexes is all available in the chart school. I have written an article on that as well. You can find that in my blog. But what it does, it allows you to upload a specific price series and use that in your charts, and thus also use it in an RRG as the benchmark. And I have created a data series that I call the 5% index. That's a price series that always goes up 5% per annum. And you can have a formula that calculates that return on a day-to-day basis. So it always goes up 5% from the start of the year to the end of the year. It's 5%, and it keeps going up and up and up. So when I stick that into an RRG as the benchmark, I'm measuring that group of securities against 5% return. So let's do that right here. All these UDIs are, they're preceded with an @ sign, so @, and then in my case, I've named this UDI 5PCT, 5%. And if I run that, and now you got to be careful here, because what I did, because I don't want to do that every day, so I created a file that actually ends at the end of 2023. So you need to scroll back to, and it allows me to actually, use this UDI until the end of 2023, and then I need to update it. I'll probably add another year of returns to it. But the reason why these are all dots is because there are no data for these stocks beyond the 14th of July in this case. So I need to scroll back to July here. So that's June, so we're now, this is the week that we're now talking. It is actually a Friday that I'm recording this, so this is actually a complete week. And now you can see the same universe, but measured against a 5% return. And you see the difference between my 5% return and my $1. And if you look at the positioning of the various stocks, you will notice that it's not much different because they're both absolute return benchmarks. What you will see is that they have shifted a little bit to the left and the right. That's the only difference. So I'm actually personally pretty happy with just using $1 because by now I can sort of gauge where things are. But if you want to have it precisely, you can stick in a UDI, a user-defined index that takes 5% returns every year, stick it in your RRG, and do your analysis, finding trends that are going up faster than 5% per year. I'm going to wrap this up. It was a really quick video to give a little bit more explanation about the different benchmarks that are available on RRG. And as usual, make sure that the benchmark has something to do with the universe. So you could stick in a yield ticker as the benchmark for a group of stocks, but obviously that won't make a lot of sense. The system will calculate it. The system doesn't care. It'll just give you the chart. So please be careful. Make sure that whatever you stick in as your benchmark makes sense with regard to the group of securities that you're looking at. Thank you so much for watching this special episode of Sector Spotlight. Looking forward to seeing you again, the new episode of Sector Spotlight. Well, whatever it is for the specials.